Welcome to The Explainer. Today, we're tackling something huge. We're talking about your single greatest financial asset. And here's a hint, it's not your salary, and it's not your savings. It's actually something you have way more of right now in your 20s than anyone else. Let's get into it.
Okay, so let's just dive right into the question that I know is probably on your mind. You've just landed a job, you're finally making some real money, but you've also got real expenses, right? Rent, bills, maybe some student loans. So is now really the time to start putting money away for the future?
And the answer to that question is a huge, resounding yes. And it's all because of this one powerful thing you have on your side right now. It's an asset you might not even think of as an asset, but believe me, in the world of investing, it's absolutely priceless.
And that secret weapon? It's time. Seriously, this isn't about having a ton of money to invest right off the bat. It's about having decades, literally decades ahead of you to let even really small amounts of money grow. And that, as you're about to see, is the most powerful ingredient there is for building wealth.
So, how does all this time actually translate into cold, hard cash? Well, it powers this incredible financial engine called compounding. Let's break down how this magic really works. Let's look at a super simple example. We're talking about just 5,000 rupees a month. For a lot of people just starting out, that's totally doable. And we're going to give it 30 years to grow, basically your entire career. And we'll assume a pretty standard 12% annual return. Now, the setup is simple, but the result? Well, it's anything but. And here it is. That simple 5,000 rupees a month doesn't just add up, it multiplies. Over those 3 decades, it can grow to an incredible 1.75 crore. I mean, just look at that number. That's not just savings, that's financial freedom. That is absolutely life-changing stuff.
So how on earth is that even possible? It's all because of compounding. The best way to think about it is like a tiny snowball at the top of a really long hill. At first, it rolls slowly, picks up a little snow. But the bigger it gets, the more surface area it has, and the faster and faster it collects more snow. That's your money. Your earnings start making their own earnings, and that growth just gets steeper and steeper over time.
Okay, hopefully you're convinced that starting early is the secret sauce. But the next big question is, how should you be investing at this age to really take full advantage of all that time? Let's look at a strategy designed specifically for you. So here's what a really smart portfolio can look like when you're in your 20s. And you'll see right away, it is heavily weighted towards equity funds, a whopping 75%. Now that is what you call an aggressive approach, and it's designed for one thing and one thing only, maximizing that growth over the long run. Let's break down what each of these pieces does. Those equity funds, that 70 to 80%, that's your engine. That's what's going to drive that high growth. Think of the hybrid funds as your shock absorbers. You know, they provide some balance. And that small little slice of debt funds, that's your anchor, just for a bit of stability. It's a portfolio that's really built for speed, but it has the right safety features in place. So why can you get away with being this aggressive with your money? It's simple. Time is your ultimate safety net. The market is absolutely going to have its ups and downs. That is a guarantee. But when you have a 30-year timeline, you have more than enough time to ride out any of those stormy seas and capture that powerful long-term growth. All right, we have covered a lot of ground here, from the power of time to specific strategies. But look, if there's only one thing you remember from this entire explainer, I want it to be this next point. It all boils down to this simple formula. Start early. Even small, consistent amounts, when you give them a long time to grow, can build incredible wealth. Don't wait for the perfect time or for a bigger salary. The single most powerful step you can take on your journey to financial freedom is the very first one you take, today. And finally, before we wrap up, just a quick but very important disclaimer. Now remember, everything we've talked about today is really just for educational purposes. All mutual fund investments do come with market risks, so it's always a good idea to chat with a qualified financial advisor before you make any big decisions. Thanks for watching.